Well, I would put 50% in physical gold, 20% in other commodities and commodity related stocks, meaning the miners, the oil and gas sector. And then we'll put 15% in cash, meaning, but I would manage cash with short dated investment grade bonds, meaning no duration above 12 months and everything investment grade. And the balance would be in the Dow Jones.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today we have a fantastic discussion lined up. We're fortunate to have with us Laurent Lequeue, founder of the Macro Butler Substack. Laurent is a multi-assets strategist who delivers actionable trading ideas based on global macro trends. He's managed international, institutional, and high net worth individual portfolios. Laurent, welcome to Metals and Miners. Thank you so much for joining us today.
It's my pleasure to be on your show, Gary.
All right, Laurent, let's begin with the escalating global trend towards resource protectionism, Trump's push for tariffs, and his interest in securing critical minerals from Greenland and Ukraine, and the increasing divergence between the U.S. and the European military strategies, where Europe is ramping up war rhetoric and military spending, while Trump signals a retreat from Ukraine. How do you see all of these geopolitical tensions impacting global supply chains for critical minerals and broader economic stability in the coming years?
Well, I think that Donald Trump has understood one thing is that the major threat for the US and the Western world is the alliance between Russia, China, and India. Because by combining these three countries, in fact, you combine the cheap access to plenty of commodities from Russia with a state of the art manufacturing in China and a consumerist economy in India. So I think that what he has implemented since he has joined the White House on January 20th is clearly based on trying to break this alliance between China, Russia, and India, and its strategy trying to appease Russia by trying to reach a ceasefire in Ukraine and Russia is in this room because he understands that he needs to bring back Russia towards the Western world. And at the same time, of course, he implement tariff is to penalize mostly China. And again, here is kind of the carrot and the stick theory. So he give a carrot to Russia and he bring the stick against China. And again here, and if you look at Greenland, it has a geopolitical interest and also an interest in terms of commodity supply. So I think he has tried to break this alliance of these three giants, which if it's not broken, in fact, would dominate the world in the next 20 years or 10 or 20 years.
How successful do you think he'll be in breaking this up?
Well, unfortunately, I think that it will be very difficult for him to be successful in this because, on the other hand, you have the European countries, and mostly, I would say, the heart of it is UK, France, and Germany. And these countries are more worried about the end of the war in Ukraine because domestically, this would mean that the president of France, the prime minister of the UK, and the recently elected prime minister of Germany will have to show something to their domestic population. And in terms of economic success for these three politician is very low, right? We can agree that over the past 5 to 7 years, since these people have been in office one way or the others, in fact, these countries have economically declined. So, unfortunately for Trump, the European politicians are clearly against his agenda. And also, to be honest, is because European politicians are still more oriented towards the globalist policies, rather than Trump is more focused on America first and prioritizing each country uh, being developing itself without being dependent of a global agenda.
Okay, so in light of all of this, how do you assess Treasury Secretary Scott Bessent's proposed economic policies, particularly the issuance of the 100-year century bonds and trade realignment through tariffs? And what kind of economic disruptions and distortions are you expecting to occur?
Well, I think here there are two things, right? In fact, the first priority of the current administration should be to reduce spending, and that's why Doge is so important, because the US has mostly a problem in terms of spending rather than in income for the US government. So the first target for the US government should be to reduce spending. Unfortunately, there also I think there's a lot of resistance inside the US to reduce government spending for one way or the other. And, and on the other side, if the US will need to issue more debt, and especially long-term debt like century bonds or long-dated yields, I mean, you need to find buyers for these kind of paper. And most of the buyers of this paper are in the institutional or the central bank kind of investor, right? And what we have seen over the past, I would say, 5 to 10 years, and especially since the conflict between Ukraine and Russia, is that foreign buyers of treasury bill of treasury bonds have kind of been on strike. And for one reason is that they have discovered that US dollar asset can easily be weaponized. So if you are a sovereign fund or a government or a central bank in East Asia or in the Middle East or in Asia or anywhere outside the Western world, I mean, it's increasingly difficult to buy US treasuries because from one day to the other, if you are not complying with the US policies in terms of geopolitics, I mean, your asset can be easily confiscated. So I think that for Scott Bessent to be successful, the US must achieve first a peace between Russia and Ukraine. And then also the US government must give some reassurance to foreign bond buyers that this weaponization of US dollar asset is over. And I think here the problem is not only that they need to achieve peace, it's also that a lot of trust has been lost from foreign bond investor into the US government. So I guess that this will be kind of a mission impossible for him, especially since, in fact, the tariff will ultimately be inflationary. And we all know that in an inflationary environment, you should not own long-dated bonds.
Okay, so you're connecting first peace in Ukraine and secondarily assurance of no more future sanctions and stealing of the sovereign wealth in order for countries to once again trust purchasing U.S. bonds.
Yeah, I think that this is the key, right? And that's why you have seen so many central banks in Asia and elsewhere replacing U.S. treasuries by physical gold. Is because if physical gold cannot be confiscated, I mean, it's the anti-fragile asset. The physical gold is stored in their own vault, and clearly the physical gold is kind of the asset that everyone should own if there's a war. So, I mean, I think that the geopolitics and the financial are very interlinked between each other. And also, I mentioned Doge, and I think Doge is very important as well because, I mean, to achieve the goal of Doge, you also need to be able to reduce defense spending. And so you can see that, I mean, everything turned around an improvement in terms of the geopolitical environment between the US, the Western world, and what I call the global south, meaning Russia, China, and its allies.
After what's happened over the previous decades, I think those assurances are going to have some real teeth for the foreign buyers to feel comfortable to not buy gold and instead buy treasuries. But Laurent, let's talk about tariffs here for a moment. Given the significant pull forward of orders ahead of tariffs, as seen in the massive U.S. goods trade deficit in February, do you believe that this pre-tariff surge could lead to a period of inflationary pressure followed by a deflationary correction once the orders are fulfilled and demand normalizes? I mean, how do you expect this dynamic to affect inflation trends and broader economic conditions?
Well, I think that the tariff first introduced a lot of uncertainty. It's not only for the US consumer, but it's also for US businessmen, but also for companies that are selling to US consumer. And on that matter, we all know that, I mean, one of the major source of inflation can be shortages or demand or the lack of trust in public institutions. So introducing tariff, even that we have seen like a lot of, I would say, pre-tariff buying over the past few weeks. In fact, what I think is that the long-term impact of tariff will be inflationary because at the end of the day, someone has to fit the bill of the tariff. So is the consumer or is the US corporate that will have to pay for it? And second, this will create at some point some shortages and problem in the supply chain. I mean, in the 1980s, Ronald Reagan highlighted that the final outcome of a tariff is a decline in terms of goods offered to the consumer and higher prices and higher unemployment. And I guess that this time is not really different. So if you want my opinion, and also the tariff are quite linked to the geopolitical environment. In fact, the tariffs are kind of a wrong way to solve the American issues. What Donald Trump should focus on, as I said, first is reduce government spending. Second, he should cut tax further, should simplify the tax code, and at the end of the day, this will bring back manufacturing to the US, and this will bring back business to the US because a lot of US companies left the US because the tax code is increasingly difficult to deal with, and the tax is increasingly high compared to other countries.
Yeah, okay. So let's move on to the Federal Reserve, their recent press conference. Do you believe that the Federal Reserve's recent decision to hold rates steady and slow its balance sheet reduction from $25 billion a month to $5 billion a month signals an inevitable return to quantitative easing?
Well, I would say first that I think the Fed is increasingly important and irrelevant for the economy because whatever the Fed decide in terms of interest rate, in fact, in a tariff era, the interest rates are not going to reduce the inflation that much. Second, if you ask me, this decision of tapering the QT, I mean, it's very technical. It's because the US government is kind of moving into a technical default by the summer around August or early September. So there will be increasingly a tight liquidity in the US financial market once the TGA has been drawn down, and probably the Fed want to anticipate this issue in liquidity in the financial market and in the U.S. banking sector, and that's probably the reason that it has tapered the QT. Will it come back with QE at one point? I think that this is possible, especially if we see, I would say, uh, like not the bank run, but I mean, if you remember in 2022, 2023, there was kind of a slow walk, bank walk among the regional US bank. I would think that in an environment where the economy will slow down, we could see once again this tightening in terms of liquidity among some regional banks. So the Fed will also try to avoid that this happen again. And I think that if we see higher inflation, as I expect due to tariff, in fact, the Fed will be between a rock and a hard place in the second half of the year.
Yeah, you're not the only one singing that tune. There's several other folks that are saying that, and I guess the liquidity air pocket caused by the debt wall that's coming is concerning many people. So the Fed might be front running that. Okay, so Laurent, the stock market has not been performing so far this year as it has the previous 2 years where we saw 20% plus gains each year. Do you believe that the recent 10% or so stock market correction marks the end of the downturn, or do you think that the uncertainty surrounding the Trump administration's policies are going to continue to weigh on market sentiment? And additionally, how do you interpret the increased pessimism reflected in the Richmond Fed survey of CFOs recently?
Well, I think that for the stock market, clearly the uncertainty related to tariff, and I mean, with the disruptor in chief inside the White House, clearly there's a little of uncertainty and no clear visibility of where the US economy and the US political environment is heading to. So this is an environment that usually stock market doesn't really like. So that's why we have seen this pullback over the past few weeks. I think that we could see some more technical pullback. I don't think that we have seen the capitulation in this correction yet. So I expect that early April, when all the tariffs are announced and put in place, we could see easily a second wave of correction. But I think that, in fact, what we have already seen this year is a reallocation between sectors. So you can see inside the stock market clearly since the start of the year, the NASDAQ has massively underperformed the Dow Jones. You had a massive, I would say, reallocation out of the Magnificent Seven and the growth stock into the more traditional sectors like oil and gas, industrials, materials. And I think that this will be the trend for the rest of the year. So you can easily see the S&P 500 down maybe 5 to 10% for at the end of the year. But you could see the last year unloved sectors like oil and gas, materials, even industrial, up single or double digit by the end of the year, while the Magnificent Seven are down maybe double digit or even 15-20%. So, I mean, the index is now so much tilted towards growth and towards this Magnificent Seven that it doesn't really mean anything anymore, I would think. So investor will have to focus on sector and focus on quality stock this year. I think that in an environment where you have potentially a stagflation materializing in the US, you need to focus on quality stocks, low leverage balance sheet, stocks with companies with a very strong track record in terms of generating free cash flow, and companies that are under-owned and still unloved. Like the oil and gas sectors or the mining industry, or as well everything that is related to agriculture, for example, or even everything that is related to the capex cycle. I think that there's a wave of capex coming in the US because ultimately some multinational will try to avoid tariff by building new manufacturing plant in the US.
So, if a new capex cycle is kicking off, are you expecting commodities to be a big beneficiary?
Well, the answer in a short way is yes. In fact, since the start of the year, the Bloomberg Commodity Index is the best asset class against everything. And I think it's underreported by the financial media, and very few investors have already taken note of this. Of course, everyone is focusing on the price of gold, but recently we have a spike in the price of copper, silver. I mean, other metals will follow, and ultimately, even the agriculture commodities will also come into play. So I think that I wrote a piece a few weeks ago about the commodity leviathan, and I think that in front of us is a big rebound in commodities, and there are different ways to benefit from this by investing in the commodities themselves or in the miners. I mean, when you look at the miners, you need also to look at the geopolitical risk of these mining companies.
All right. So, Laurent, gold, you mentioned gold. It surged past $3,000 an ounce recently, driven by strong economic and geopolitical factors, including inflation, European war threats, tariffs, weaker dollar, so much more. The rapid rise in gold, it moved from 2,500 to 3,000 in just 194 days. It's pushed gold to 3 standard deviations above its 200-day moving average. Does that level to you signal a potential pause and consolidation in the days and weeks ahead before another leg higher? And where do you see gold going to close out 2025?
Well, I think that as of today, gold is clearly technically overbought. I mean, we all agree on this. But there are a lot of factors driving this performance of the price of gold. So I think that technically we could easily see a pullback in the price of gold, especially if we see some improvement in terms of the geopolitical situation in Eastern Europe or in the Middle East. But ultimately, one of the driver of the gold price is also this geopolitical environment, right? Because we all know that gold is the metal for war. And if we see more war or a deterioration of the geopolitical situation in the Middle East or in Eastern Europe, or eventually possibly also in Asia, I would think that this would be a big catalyst again for gold. Outside this, as I said, if the US move into an inflationary bust, as I think it's highly probable by the second half of the year, I mean, this is also a big tailwind for the gold price. So I would think that, I mean, I don't give investment recommendation here, but I would think that we will see a pullback in the price of gold. But let's say if we see a $200 pullback in the price of gold, this would be a big buying opportunity or an opportunity to add more gold for investor, because I think that we cannot rule out to see gold even around $4,000 by the end of the year, depending of the geopolitical environment.
Yeah, it's interesting. And since the breakout in gold last year, really every consolidation period, pullback period, it's been short. It's been met by folks buying the dip, and it just keeps pushing the metal higher and higher. So, I would agree that that's probably the likely path once again. We're not at the bull market is just starting. But despite gold closing above $3,000 for 7 or 8 consecutive days, U.S. money managers liquidated $93 million out of GDX the other day. And the previous week, it was 242 million. What do you think explains the disconnect between the strong performance in gold versus the significant outflows from gold-related ETFs? Is this a sign of poor financial decision-making, or is there a broader strategic reason behind these liquidations?
Well, I think that gold is still underowned and unloved by most of money manager in the US. And I think that most money manager in the US and elsewhere in the world are still too highly invested in bonds, in government bonds. and too lightly invested in physical gold. So I think that here, uh, I mean, they've never been a very good indicator for the future of the price of gold, and I think that uh, I'm quite happy that they are continue to lag behind, because it means there's still a lot of opportunity for a lot of people to own gold in their portfolio. In fact, in my work, I look at the brown permanent portfolio. I mean, which look at the four asset class: cash, bond, gold, and equities. And if you look at history, once the global economy moved from the inflationary boom into an inflationary bust, I mean, you should at least own 30 to 50% of your portfolio in physical gold. And I think even as of today, I can count the number of investors who own 25% of their portfolio in physical gold on my hand, maybe, or my two
Yeah.
hands, maybe.
Yeah.
So I would think that we will see again probably a lot of outflow, inflow. And as I said, on the back of this, you still have the price insensitive buyers like the central banks in Asia and in the Middle East, which will continue to buy until they have not been reassured that their assets are safe again in US treasuries. And to
Yeah.
be honest,
That seems to be a long way away.
yeah, so I think that in fact, I mean, you could see pullback also in gold price. Is Doge shows some results, significant results. So this would bring some hope for people that treasuries are once again investable. But I mean, at the end of the day, I don't believe that Doge can really change the needle in terms of the trend in the US deficit. And also, the key here is also the end game in geopolitics.
So, Laurent, recently JP Morgan came out and gave a big upgrade of the mining and metal sector to outperform from underperform. They're the world's largest bank, by the way. Do you expect this shift by JP Morgan to lead to increased institutional and retail investment in mining stocks?
I don't think so, to be honest. I didn't even know that JP Morgan has upgraded the sector. I feel that it's completely irrelevant to know what they do and what they think, because most of the time they are wrong. And if they are not wrong, it's because they have an interest to boost one stock or one sector one way or the other. So I feel that, I mean, investors that have, I mean, they know physical gold, they know precious metal, and those who have done their work in terms of the mining industry, I mean, don't need J.P. Morgans to tell them that the sector is cheap.
Good point. All right, so for the 2 weeks of March 10th through the 21st, a total of almost 35 million ounces of silver had been deposited into the COMEX vaults. That's more than 1,100 metric tons. How unprecedented is this? I mean, that's more silver than the entire world has mined over the past 2 weeks. Why is there a silver rush going on right now?
Well, I think that this is similar to what we have seen in gold also over the past few weeks. You have been a big shift of physical gold and physical silver from London and from Zurich into the American vaults. I think this is also one sign that some investor and the smart investor are getting worried about the evolution of geopolitics and also economic development in Europe. I mean, at the start of the year, I put in one of my 10 forecasts for the year that there will be some capital control implemented in Europe. And I think that it's more and more likely, because when I look at the outlook of the government debt from France or from the UK and now even from Germany, I don't even know how the governments can keep their door open in Europe without imposing capital control before the end of the year. So I
Wow.
guess that this shift of metals from London and Zurich into New York is clearly a trend that a lot of people start to anticipate that there will be a big capital control implemented by the second half of the year in Europe.
Well, you're painting a really interesting picture between the second half of the year in Europe and the second half of the year here in the United States. So it sounds like the G7 is facing some really challenging headwinds in the second half of 2025.
Well, I guess that every country has its own challenges, and but I would be more worried first about Europe than the US. The US, I would think that we will see an economic slowdown because of the uncertainty related to tariff. You will see higher prices. But in terms of performance of financial asset, I think the US will do very well, especially the Dow Jones stocks and all the sector that I mentioned previously, like oil and gas, materials, industrials. These sectors will probably do very well in the US. In Europe, to be honest, I'm not really sure what they are trying to do, because they are trying to play a war game that they cannot afford. And so, as I said, if you look at the recent decision from the German government, the government has decided to borrow money to spend more on defense. I've seldom seen a successful and prosperous country uh, developing on higher defense spending based on higher public debt. So this is to me a recipe for a big collapse. But clearly, I would think that France and UK are one step ahead than Germany in this scenario.
Well, I want to welcome everyone who's watching to this fantastic interview with Laurent Lequeue, founder of the Macro Butler. This has been a wonderful discussion so far. And before we wrap up here with our final set of questions for Laurent, I want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. Consider upgrading for access to premium content. All premium content provides a comprehensive analysis of global trends, asset sentiment, and deep dives on individual miners for more informed decision making. Even without premium, there's plenty of free content daily. So visit metalsandminers.substack.com to join us and explore. And thanks again for watching this interview. Now, I'm positive that you've enjoyed the conversation today with Laurent as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video. Laurent, let's finish off this discussion we're having with what I call a lightning round. I'm going to ask you to rank a few assets as a buy or a sell by giving it a score of 1 to 100, with 100 being an extreme buy and 1 being an extreme sell. Just give 1 or 2 sentences as to why you take that position. It is a lightning round. And if it's an asset you're not following, that's okay. All right, you ready?
Ready.
All right. On a scale of 1 to 100, is gold a buy or a sell, and why?
What's your time horizon?
Well, let's say this year, right now, starting now.
I would say 80, but as I said, on a $200 pullback, it will be 100.
Okay. Gold miners.
I would say 60, because I think that I would rather own the metal than the miners because of the geopolitical risk linked to the miners.
Silver, 1 to 100.
Well, same as gold, on a 10% pullback is 100.
Okay. Silver miners, 1 to 100, and why?
60 as well, I guess, is the same story as for gold miners. I would rather own the metal than the miners, given the uncertainty related to geopolitical environment for these companies.
Okay. Copper.
80. I think that copper will go much higher in the next 24 months. And here again, a pullback would be a big opportunity. In fact, all the metals are a buy on the pullback or straight, depending your time horizon.
All right. Uranium.
Or I put for 50. The reason is that, I see the need of uranium here in Asia. But for the US, in fact, I would think that the US would be better off using cheap natural gas to power its economy.
Do you make a distinction between uranium and uranium miners?
Yes, I would think that uranium miners are even more risky than gold and silver miners because usually they are in very exotic jurisdiction outside Canada. Other jurisdictions are very exotic.
Okay, so you have uranium at 50, and I think you had the miners, gold and silver, at 60. So where would you put the uranium miners?
I would put at 40.
40. Okay. Let's look at oil.
Or is 100 at market. I think that WTI below $70 is a bargain,
Okay.
and
NASDAQ. Oh, sorry.
it goes much higher even with baby drill. I think that in a scenario of a war in the Middle East, it can easily go to 150 or 200.
Okay. NASDAQ.
20.
And why?
Well, I think that, as I said in the first part, that this year is the year of the rotation. So everything that has done well last year, like NASDAQ, Magnificent Seven, will underperform. And in fact, there are only a few stocks inside the NASDAQ that I would look at, and they are not among the Magnificent Seven.
Okay. S&P 500.
60. I think that it's better than the NASDAQ, but I would prefer to buy the Dow Jones rather than the S&P 500.
Okay. Short-term treasuries.
50. I mean, if you want to keep your cash waiting for an opportunity to buy more physical gold or more Dow Jones stocks or more oil or more copper, is a good place to be, but you are not going to be safe in an inflationary environment with short-term treasury bills.
Long-term treasuries.
20 is like the NASDAQ.
Okay. On a scale of 1 to 10, with each representing a percentage like 1 or 2% or 2.5%, where do you see inflation ending the year 2025?
Or around 4 to 5% CPI in
So
the US.
you see an uptick coming.
I see an uptick because there will be a base effect and there will be the tariff impact. So I would think 4 to 4.5%.
Okay. 1 to 10, with 10 being the highest probability, we're heading into a recession before the end of 2025.
It depends what you call a recession. If it's the recession as defined by the US government, I'm not sure.
Yeah, let's
I
go
would
with that.
think, okay, defined by the US government is almost zero probability. But in fact, I look at the S&P to oil ratio and the position versus the 7-year moving average to see if the US is in a recession or not. I mean, we are still well above the 7-year moving average, but I would think that by the end of the year, we will be below the 7-year moving average, meaning that by the fourth quarter of 25, you could see a recession based on this indicator.
Okay. And lastly, the recommended portfolio allocation used to be 60-40 with 60% stocks, 40% bonds. This seems to be changing greatly. If you were to include all the various asset classes from commodities, precious metals, it's miners, whatever, et cetera, what would your approximate recommended portfolio allocation look like today?
Well, I would put 50% in physical gold, 20% in other commodities and commodity-related stocks, meaning the miners, the oil and gas sector. And then we'll put 15% in cash, meaning, but I would manage cash with short-dated investment-grade bonds, meaning no duration above 12 months and everything investment grade. And the balance would be in the Dow Jones.
So you're completely out of the NASDAQ.
I would be completely out of the NASDAQ. I mean, I would still own some tech companies via the Dow Jones, include the companies that are included in the Dow Jones, but I would be completely out of the NASDAQ. I think that, I mean, the other sector that I would look at is aerospace defense. I think that you will always need to have a 5 to 10% allocation to aerospace defense.
Okay. Well, Laurent, this has been wonderful. Thanks for coming on to Metals and Miners. You've been so generous with your time, analysis, and ideas. Would you please share with everybody who's tuning in a key takeaway that they can basically walk away from, keep in mind, and also inform everybody who's watching where they could learn more about your work and how they can connect with you?
Well, I think the key takeaway is that we are living in an uncertain world. There are a lot of challenges in front of us. I mean, in front of all investors and non-investor. I mean, I think that in this environment, people must stay steady, healthy, focus on what is important for them. So also focus on their loved ones is sometimes the most important. Good health is as important as the good wealth. And in terms of investment, I think that don't listen too much about around the financial media. Keep buying gold, keep buying quality stocks in the US, and keep looking at commodities as a way to protect your wealth in a world that is increasingly dangerous. But there's hope. I'm not going to end on a negative tone. I mean, there's always a hope. And I can see the bright light at the end of this tunnel. And I mean, hopefully we will all reach this end of the tunnel healthy and wealthy. And for those who want to read more, they can Google the Macro Butler. I write a weekly Substack. It's free. And for those who want to be in touch with me, they can send me an email at info@themacrobutler.com. And I always reply to all the emails and I read all the comments of all the video I make.
Wonderful. Well, I've really enjoyed our discussion today, and thank you for being here. I look forward to having you back on sometime soon, Laurent. And everybody else, thanks for watching.
Thank you, Gary. It was my pleasure.
Well, I want to welcome everyone who's watching to this fantastic interview with Laurent Lequeue, founder of the Macro Butler. This has been a wonderful discussion so far. And before we wrap up here with our final set of questions for Laurent, I want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio.